First home buyers are rushing for government-backed loans. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this domain article discussing the government-guaranteed loans. You know, that wonderful scheme that we have, which is our first step down the horrific path of government-guaranteed loans that the US has taken. I'm sure we won't repeat the mistakes of other countries. We've never done that before here in Australia. Not at all. Come on, guys. You know, 5%. Why? 5%'s huge loan deposit. That's all you need. Just wait for them to say 1% or no deposit home loans. Government guaranteed. Just wait. It'll happen. So, first home loan deposit scheme is almost full 4 months after it opened, according to new data. There are few chances left for first home buyers to snap up an established property with a low 5% deposit while avoiding mortgage insurance, new figures revealed. Only 4 months since it opened, there are just 363 places left across the country out of the 10,000 spots released at the beginning of this financial year as part of the federal government's first home loan deposit scheme. Well, there you go. So it's pretty much full. By the time you read this article or watch this video, they'll probably be gone. Some 5,332 buyers have purchased using the program since July, while 4,305 have reserved a place and are looking for a home, Treasury figures showed. Among those who already bought, the majority were from Sydney, 965, Melbourne, 823, Brisbane, 763, and Perth, 373. It comes at a time when first home buyers have been keen to get onto the property ladder, with the proportion of first-home buyers at a decade high accounting for 41.4% of all loans, according to ABS figures. And this is just the problem we have in Australia, everyone. It's a property ladder. You've got to get on it. Everyone wants to get on it. That's all it is in the media everywhere, because then you make free money. You literally make free money. You can make more money just sitting on property than you can in starting a business. And there's less hassle to deal with it. And then you can make money off your property, renting them out, your little landlord empire, and then negative gear any income you make off other property. Just keep going and going and going. It can be a snowball effect. But the problem is that disincentivizes people from investing and growing other parts of the economy. It creates a bubble in this sector, and that's what we're seeing. What's going to burst the bubble? Is there any incentive at all for the politicians to not jump in and manipulate the market to prop everything up? This is what we're seeing here, where the government is paying these costs for people, which would cost a significant amount of money, to allow them to get in on housing. And it's either providing people with the capacity to spend more, that 20% deposit can now only be a 5% deposit, and they can use that to buy a bigger and nicer house. And you know what that's going to do to property prices, everyone. I'll give you a little hint. I'll bring up this chart here. It's going to inflate the prices. But don't worry, Florian, property isn't really captured in inflation. We'll have to see. Inflation figures come out tomorrow, everyone. Where do you think it's going to head? So Mortgage Choice, DY broker, James Alger, said the scheme had all but stopped taking applications due to the sheer demand. Compared to January, February, the first 10,000 spots, the July-August appetite was huge, Mr. Alger said. Every lender I've spoken to has said they're massively oversubscribed. The pandemic produced a counter effect, drawing more first-home buyers into the market with the perception there were good buying opportunities. Now, this is the thing. Let's hope we're not seeing a dead cat bounce. And, I draw a little diagram. This is a dead cat bounce. Market's going up. Oh, fantastic. Oh, it's gone down. Crash. Goes up again. And then goes down again. Continues its decline. Could this be where we are now in a dead cat bounce? So people see, oh, look, it's a good time to buy. Jump in. And let's just bring up. I'll bring up a chart. Could we be seeing this in property? Because we have all of these interventions, all of these government propping up the property sector. Let's just go here to images. And you can see examples here. Here we go. Here's a dead cat bounce definition. There you go. Up, continuing down. No, we don't have one. Here we go. Another one. Up, continuing down. Because I mentioned it a few times and some people ask, oh, what is it? I haven't heard of it. It's something in trading. Could that be what we're seeing in property? I put that question to you, everyone. And are the first home buyers getting, vacuumed into these type of things? So what if you bought here and, okay, property goes down and then you got to sit here for a while before it shoots up again? If this time frame doesn't matter, if so long as you're in the house and can service the mortgage, it doesn't matter. As long as you keep employed, it may make people a bit frustrated, but we'll have to see, everyone. Because what other magic tricks can the government pull out to prop up property? We've got JobKeeper keeping businesses going. We've got mortgage holidays. Some have been extended into next year. We've got businesses trading while insolvent. They're allowed to do that now. It's nuts. You've got government grants, state government grants, federal government grants, all supporting housing. I suspect next it's going to be, we'll have to see how they try and pull more migrants into the country to increase demand. Or maybe it'll be more like taking the Hungarian model, encouraging people to have bigger families. But that won't be quick enough to prop up housing. So all the major banks have closed their wait lists, he said. There's no clear line of sight on whether there will be another 10,000 spots in January, especially with the latest spots in new builds. The government this month has announced an additional 10,000 spots in the scheme this financial year on the condition buyers bought newly built homes, but those places are yet to be released, and another 10,000 places were opened in January for financial year 2020. Even those interested will need to buy newly constructed or near completion homes, according to Melbourne-based mortgage broker Pierce Financial Director Tom Pierce. And that's the thing. Because they're going to steer people towards new build, it's going to have a downward pressure on the existing stock. So they'll be propping up the subbies and the builders on one side, helping them keep their business going, but then they're pushing down on the value of their houses on the other. So, nothing is without consequences ever. It needs to be built and ready to go, he said. We don't know if they're going to have a spot in the scheme in 18 months' time or whether the scheme is still in play. It's really difficult when people call you with off-the-plan places. It's being rolled out on a 6-monthly basis. We've learned as we go. The majority, 35% of applicants, are aged between 25 to 29 years old, followed by 18 to 24-year-olds, who make up almost a quarter of applicants. Applicants assessing the scheme put down an average deposit of 6%, but many have saved more but opt to save cash for a rainy day fund due to the pandemic-induced recession, brokers said. And that makes a lot of sense. I completely understand why people are doing that. If there's no incentive to pay it off now, you hold it for 6 months, hold it for a year, and then just dump it on there. The interest costs of having that rainy day fund are probably worth the peace of mind and reduced stress you can have. But the thing is, are we going to see a whole generation of people, or a whole chunk of this demographic, potentially stuck in negative equity if there's a big correction? We see it. I mean, if you're jumping in housing, probably less risk of that happening than if you go into apartments. That'd be crazy. Ray White, Surrey Hills director, Erson, said he had seen an increase in first home buyer activity in the past fortnight. I've definitely seen and felt just in the last 2 weeks an increase in numbers from just first home buyers in terms of inquiries to inspections to contracts to people actually bidding and buying, he said. Adding that buyers were expecting reduced property prices due to the pandemic. There are more important things. Better than the recession or the virus is that interest rates are really low at the moment and banks are lending. That's a driving factor, he said. There's a lot of bank of mum and dad. 60% of scheme applicants are individuals and 40% are couples. 40/40 finance director and mortgage broker Will Uncles said first home buyers are lucky to gain access to the scheme and should aim to get their foot in the door in other ways. There's 110,000 first home buyers a year, and that's 10,000 spots on this list. You've got a 1 in 11 chance of getting this spot, theoretically, he said. To get a spot is fortunate. It shouldn't be the only way to get into property. And he makes a legitimate point there. So there we have it, everyone. First home buyers are rushing to get into this scheme. Are we just seeing a dead cat bounce? Will people potentially be stung by it? And does it matter if you've got a long enough time frame? What do you think? And a lot of people are worried about the cash rate going up again, particularly those that remember the insane high rates that Australia had back in the early 90s. You can see it on this chart here, or late 80s. Can you see that returning? I think the market would punish the Reserve Bank if it happened. And I can't see there being political will to allow it. They're going to try and creep it up when unemployment gets back down. But as we're seeing, it really should be tied to the number of people on welfare. It shouldn't be tied to the unemployment rate. And if we bring up this chart here, we can see, the proportion of Australians on welfare of our working age population is sitting around 10%. Maybe we need to get that down to 5% before they can actually increase the rates. What do you think? As always, guys, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and I will see you all in the next episode. Bye for now.